Welcome to Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Beko and my partner, Hari. It is 3 Ps today. Looking
Fancy.
nice. You guys, if you are listening on podcast, please go check out our YouTube because he is looking fancy today in the 3 Ps. Okay. In previous 2 episodes, we talked about the overview of all the ratios, financial ratio, operational ratio, as well as the, I forgot the third one, financial ratio, valuation ratio, sorry.
Yeah.
So 3 episodes we did
The
overview.
Value Investor Podcast.
It is, after all, Value Investor Podcast.
Yes.
So we looked at the overview of all 3 ratios. And in the very previous episode, we talked about the valuation ratio in detail. In this episode, we're going to talk about operational ratio. So what is operational ratio? Operational ratio is our ratios, our metrics by which investors analyze how efficient a company is ran. How much, like for example, like an engine, for example. If an engine is being efficiently ran, you don't have to, it's not guzzling gas. It's not muzzling gas to, go 10 feet, for example. Like if it's efficient, every liter of gas will, whatever. That sort of ratio can be applied to companies also, and that's what we're going to look at today. So let's start off. We have a list of operational ratios that we want to go through. Let's start off on the top of the list here with gross margin.
Yep.
We talked about this in our income statement, but please, Hari, define what it is for us and why it's important.
So gross margin is the revenue minus the cost of goods sold is gross profit. So when you get to gross profit, you take gross profit divided by revenue. So what that's really telling you is, for every dollar in revenue that they generate, what is the cost of actually making the item, right? So that's not people, it's just the raw materials, how much does it cost? So what you would want to kind of see here is, if company sells multiple products, and their gross margin is decreasing or increasing, right? What you're looking for is, well, did the cost of the materials actually decrease?
Yeah.
Or did the mix of things that they sell change? Right.
Yeah.
That's, for the most part, that's the only 2 ways that you're going to see a lot of the gross margin differ. Now, if your business is something like a services business,
yeah,
your gross margin may actually be close to 100% because you don't really have a cost of goods sold because you're not selling a good, you have a service, right? Mm-hmm. So, just because you see the number being really high doesn't necessarily mean that it means a lot to you. Like, for example, like Costco has a very, very low gross margin, but that's because they are a volume retailer. They sell a lot of items. Walmart is the same way. Amazon is somewhat similar to that. Whereas if you're like a non-discount retailer, like let's say Macy's, their gross margin may be 40 or 50% depending on how things are structured. Mm-hmm. So, things may be different. That gross margin shouldn't say that, you have to compare apples to apples in every case. And so saying, Costco's gross margin and Accenture, who's a services company, gross margin are, they're vastly different. So Accenture is a better company is not a good way of measuring things. So.
Right. It's just totally different industries. So
Yeah.
you got to focus on a specific industry if you want to compare gross margins to each other.
Right.
Okay, let's move on to the operating margin. We talked about this also as a way to compare different companies within an industry.
Correct.
Tell us about that, Hari. Operating margin.
Yeah. So when you look at operating margin, you start, like we've already gone down to the gross profit, right? And so now we subtract out selling, general, and administrative expenses. We also subtract out research and development. And so basically what we've done is what does it cost to pay the people who work at this company to build, this item, right? We also take out marketing expenses. So it's not the item itself, but it's the cost of the item, the peripheral things that bring the item to market, right? Which is you have to go and get you market the item on, with advertising and that kind of stuff. You have to pay your employees, and you have to have executives who are running the company and so on. So if you were to, let's say, decrease your advertising budget for 1 year, your operating margin may go up. But the long-term effects of that may be that fewer people know about your product, fewer people buy your product.
Sure.
Right? And so there's a balancing act here, is that if you're spending too much money on the operating margin side of the house, right, what you're doing is, decreasing obviously your profit, right? But there's a flip side to it, which is you could be potentially investing for the future growth, right? And so a lot of companies, especially in retail and things like that, will have heavy advertising, say around Christmas season and things like that. Hey, come to our store. We have our Black Friday event, which is coming up here in a few weeks, and so that kind of creates a lot of expense for that month. But then they have an enormous uptick in their sales during that time. So, what you really want to look for is, over time, how is that operating margin changing, right? Is it increasing? Because if it is, that may be a very good thing. Like, they've cut costs. Maybe they've, gotten rid of a bunch of middle management that don't really add any value to the company, or, they've found a cheaper way to get things to market, right? Or better ways of advertising that don't cost as much. Maybe instead of doing TV ads, they're using Facebook or internet, and that turns out to be cheaper for them. You'll have to look and dig in to find out what that is. But I would say, if your operating margin is probably one of the most important margins for you to look at when you start evaluating companies and looking at it over time. And if you can find a direct comparison, it may be good to look at that, across multiple industry, across the industry.
Yeah, the operating margin is very, very important. Again, I just want to clarify what we're talking about in the context of financial statements. We're talking about, as you start from the top line revenue, you're deducting all the expenses. And operating margin, gross margin, like Hari talked about, takes out the cost of goods sold. That's the gross margin.
Right. And
then from there, you take out SG&A and R&D expenses.
Right.
Take those out, and you arrive at operating margin.
Yeah.
And that's what Hari's talking about here, operating margin. So to calculate that, you basically take the operating margin, which is EBIT also. It's synonymous. You take that, divide that by revenue.
Correct.
That's how you get the margin percentage. Very important to consider, especially like Hari talked about, when you want to compare within an industry, also over time within a company. Yep. Let's move further down the income statement and get to our net profit margin. Tell us about that and why it's so important, Hari.
So net margin is important because that's the amount of, so if you have $100 in revenue, what goes to the bottom line, right? That's what that number tells you. So, if your net margin is 2%, then for every $100 you sell, you're going to have 2%, right? And so one of the things that you do with these numbers is, companies will say, we're targeting so much in revenue this year, right? And if you estimate that their operating margin is going to be, say, 10% or 20%, you can estimate what their profit will be, based on that. Same thing with the net margin. If you know that they have a historic net margin of 5 or 6%, and they're projecting revenue, because companies will do this, next quarter, next year, we're projected to earn this, you can kind of, back calculate what is the margin or what is the profit that they're going to generate there. And so you can also put different scenarios where they say, well, our operating margin is going to be between 8 and 10%. Well, so then using those metrics, you can calculate a high and a low, kind of range for their profit. So, so the idea here is that using these metrics is to help you identify what is the value, right? And so for net margin, right, so we're taking operating profit, now we're subtracting interest, and we're taking out taxes, right? So last year, the Trump administration passed the Tax Cut and Jobs Act, which essentially cut the corporate tax rate down from 38 to 21%. So, that's almost cutting it in half, right? So you would imagine that a lot of these companies have a big jump in their net margin, right? And if you were to look, at that, you would probably see that their operating margin didn't change, but then suddenly their net margin would have increased, right? That doesn't mean that, that's obviously out of the control of the company. They can't, decide to not pay as much in taxes. Now, what is in their control is how much debt that they have and how much, because that's how they financially, how they finance the company, I should say.
Yeah.
But typically we don't use the net margin because companies may operate in different tax jurisdictions and they may have different financial structures. So depending on how much debt they have and how much equity they have, you don't want to use that necessarily. So the best thing to do in that case is actually to stay with the operating margin, because the operating margin is a better measure because it doesn't take into account their tax jurisdiction and so on.
Yeah. So just to recap those three metrics, because I think those three kind of bundle together. Gross margin, starting from the top, take out revenue. From revenue, take out cost of goods sold. That's where we arrived at gross margin. Operating margin, you take out SG&A and R&D expenses, and then from there you also take out tax and interest, which puts you at net margin. But like Ari said, depending on jurisdiction, depending on your capital mix, the capital mix of the corporation that you're analyzing, net margin might change over time or might change depending on the jurisdiction.
Yep.
So important to keep that in mind when you are calculating the three ratios. Okay, so those are the three margins and profit margins that we wanted to look at that kind of bundled together. Now let's move on to the other list that we have prepared for you guys. Let's move on to operating ratio. Let's start with that. Tell us why it is important. Well, tell us what it is and why it's important for us. Sorry.
So it's the operating expenses divided by net sales. So it's essentially telling you what percent of their sales are spent away as expenses, right? As operating expenses. So not cost of goods sold, but selling, general and administrative. So marketing expenses, people's salaries, the executive pay, and research and development. How much of those expenses are as a percentage of sales, right? So this is essentially like using the the operating margin, but the difference here is that the operating margin also includes you've subtracted out the gross the cost of goods sold. So this kind of lets you narrow in on, if you're comparing two companies, what percentage of their sales are being spent on on the operational side. So all else being equal, right, the company that is able to spend less on their operating expenses because, for example, let's say that your company's headquartered in San Francisco, right, and, you're paying your employees, almost twice as much as if you were paying them in, say, Texas. That's something that you can identify quickly with, the operating expenses if you have two companies to compare against, right?
Yeah.
Now, that's, maybe there's a good reason that they're in, in a geographic location and so on. So, maybe they have different, different kind of thought processes as to why, maybe one has a much higher advertising budget, and one has a higher research and development budget. So these are all things that you have to kind of be careful about where you apply these metrics, right? Yeah. So just like within, if you're familiar with statistics and other things, you can plug in any numbers into any formula and get a number. That doesn't mean it's correct or meaningful, right? And so knowing where to apply these is really important.
Mm-hmm. Yeah. So operating ratio, again, it's almost like a negation of operating margin.
Yeah.
Right. Operating ratio. So all the three ratios we talked about above: gross margin, operating margin, net profit margin. Those you want it to be high.
Yep.
You want those ratios to be high for you if you want to find a good company, right? Operating ratio is actually the other way around, because you're not taking what is left on the numerator. Instead, what you're doing is you're taking the expenses on the numerator and dividing that by revenue. You want that to be as small as possible.
Yeah. Now,
all else being equal.
No. I mean, one thing I'll say about this is none of these things tell you how profitable a company actually is, mm-hmm. right? And that's something that's different, right? And so we'll talk about that here in just a minute when we talk about profitability ratios, mm-hmm. right? Because that is like I said, Costco has a very low net profit margin, right? It's like 1 or 2%, but they have a very high profitability ratio relative to the amount of money they have to invest, to generate income.
Yeah.
Right?
Well, I think that's a good segue. Let's actually move on to the profitability ratio we have prepared for you guys.
Right.
Okay. Well, one of the first things, the first that we want to look at, I think it's you might argue that it is most widely used of the profitability ratios, is return on equity.
Yep.
Return on equity. Also, ROE. Sometimes people truncate it to ROE. Tell us what it is, and why it is so important.
Yeah. So I think this is probably the most important ratio that we're going to talk about today, and probably the most important ratio in all of investing for a lot of different reasons, right? But this is one of Charlie Munger's, who's Warren Buffett's sidekick at Berkshire Hathaway.
Sidekick.
Yeah.
Yeah. Go ahead.
They are, they use this heavily as a measuring stick for evaluating a company. So what is it? So net income. So we've taken the net income and we go to the balance sheet and we look for the shareholders' equity line, right? So remember, assets minus liability equals equity, right? And what are we actually measuring when we do this? One of the things that we're saying when we do this is when you take the company's net income and you divide it by the equity, you're essentially saying, if I invested another $100 into this business in terms of equity, what is the rate of return that I would get if I did that $100? So if you have a company that returns a 5% rate of return, right, you are almost better off investing in the S&P 500, which can give you a 7% return. Now, if I find a company that gets me a 15% return on equity, I'm better off putting my money back into the company itself, right? Buying more equity so that I can grow my business into get a 15% return. Now, not all return on equities are equal. For some cases, businesses have maxed out what they can invest in, right? They can't grow their business anymore because there is no more blue sky for them to grow into, right? Think about a company like Macy's, right? So Macy's has been around for 150 years, and they have basically any town that it could, afford to have a Macy's, that they could, be viable in, already has one, right? There is no more new places for them to really put their money into. So regardless of what their return on equity is, it's all legacy at that point, right? Whatever they've already invested, what is their rate of return, right? But the reason this thing is so important is if you're buying a small growing company and they have a very low return on equity, that likely means that your long-term rate of return on your stock, like the profits that you will get out of buying that stock, will roughly equal the return on equity of that company. Right, so I can't emphasize that enough I'm going to say it again. The long-term profits that you will gain in terms of share price over a long period of time will roughly mirror what you get in terms of the return on equity for that business. Okay, so when people say, "Well, I don't know how if this company is going to continue to grow and all that stuff," if their return on equity is, if they're in a business where they have the ability to grow, then they are going to grow roughly at the return on equity valuation,
right,
or the number. Okay,
yeah.
So we talked a lot about, I gave you all of the why, right? For that, and I think this is probably one of those things that we probably have to expound on in a later episode because it's such an important concept.
Yeah. I just want to mention one thing there. I think what you said at the end. Your return on your stock purchase, your return over time is going to equal the ROE number.
Yeah.
And I think a case in point, for example, we were analyzing a bank, the bank that we owned, but we were also analyzing another bank that was kind of on a similar size, but their return on equity was quite low. Actually, it was like 3% or 4%, something like that. And you can see over time, they started around roughly the same time.
Yep.
And if you look at the stock price now, the compounding annual growth rate is about the same, like about that.
Yeah.
And so, again, kind of to Hari's point, ROE, one of the most important metrics that you have to understand. Again, what it is, it's a net income divided by shareholders' equity that you find in balance sheet.
Yep.
Very, very important. Okay. You want to move on to the next one? Return on assets.
Yeah, so this one is kind of a, I don't use this very much. And, so return on assets is basically net income over the total assets the company has, right? And so the reason I don't use it is it doesn't take into account, the equity component of this, right? So equity is always less than the assets, right? And so when you see this number, return on assets is almost always lower than, is always lower, but could be equal to the equity number, right? And so why this number is kind of there is it is still a profitability metric, right? But companies don't, if I buy a new piece of equipment, right, as we talked about in the financing, section, when we looked at the income statement, cash flow statements, if I have cash and I convert it into a piece of machinery, right, because I buy something, my assets don't change, right? And so my equity doesn't change either, right, in that environment. But if I finance it with debt, my equity actually could increase, right? Because, depending on how the financing works. And so what it doesn't tell you really is, what is the financial structure of or purchase of that item. And so it's best to always consider this in that context. And looking at return on equity, the flip side to that is if you have too much debt, then you can actually artificially make your return on equity look high, right? So the company has $100 in assets, and then they and $20 in liabilities, they have $80 in equity, and then they flip they just get a bunch of debt, and then the return on equity increases. Yeah. That's not that's not what you're looking for, right? So what you have to figure out when you do this is, and we'll actually talk about this using the debt plus the equity in another metric, but what I would say is return on assets is probably, there's a lot of financial companies that, people use that metric, sometimes in heavy machinery companies, but for the most part, I don't really pay attention to it. Return on equity, I think, is more valuable.
Mm-hmm. Yeah. Return on asset, again, I just want to reiterate this fact. Asset, you find it in balance sheet.
Yeah.
And return on asset, return on the top numerator in this case is net income. And again, asset doesn't take into account the liability. It takes into account the entirety of assets.
Yep.
And so you can, like Hari said at the last bit there, that you can fudge the numbers here by just by loading up with debt. And so the ROE looks artificially high relative to return on assets. Okay, let's move on to the next ratio, return on capital employed. This is kind of a variation. Again, all these ratios that we're going to talk about here: return on equity, return on asset, return on capital employed, return on invested capital. All these is a slight derivative of basic formula of you have some measurement of profitability at the top, divided by some measurement of asset or equity in the company.
Yeah,
that's always that derivative of all these ratios are just derivative of that basic formula, and so return on capital employed is exactly the same. And so define for us what it is first and why it's useful. Right.
So your top line is actually not net income in this case; it's actually EBIT or operating income, and then you divide it by what's called capital employed, which is equity plus debt. And sometimes you will also see that they will back out what they call excess cash. So excess cash could be, if a company has. So I don't like this because there's some gray area here, right, as to what is excess cash, right? So if a company has a lot of cash on their balance sheet, they may not be employing it, so they put it into short-term investments and stuff like that, and those give you like a 2% return. Obviously, I don't want to consider that in my cash or in my return on equity, because that doesn't tell me what's the actual operating business, right?
Yeah.
So the idea here is to say, what are the assets that are being used, and what is the debt that was being used to actually do something, right? And so what you're trying to look for is, obviously, the higher the number, the better, but you have to kind of adjust for, some companies have a very large cash balance sheet because they generate a ton of cash, and then they have nowhere to park it. And so they're just waiting to, buy another company or do a share buyback or something. Or it's in a foreign bank account, and they can't, easily repatriate it without paying a lot of taxes. So they just kind of sit on that money. And so you subtract that number out from the assets and liabilities that so you equity plus debt minus some of the extra cash.
Yeah.
So some people, what they'll do is they'll do it with no cash subtracted, and some will do it with all cash subtracted, and then they'll just kind of see what those numbers look like.
Mm-hmm.
So typically what I say is, and some people will also say, well, they need 5% of their cash as working cap, everything above 5% of, working capital is, or I'm sorry, everything above working capital is excess cash, right? And so there's different ways of doing this. I don't really, you can, kind of pick one that you feel comfortable with, or the better thing to do is use all of them and then look at kind of what those trends are over time, to measure it.
Yeah. Excuse me. So return on capital employed. Again, capital employed, I think, kind of says a lot about this metric. Capital employed, if you think about that word, it is capital that is employed, it is deployed in the business to make the business run.
Yeah.
And so debt and equity, and you subtract excess cash, and it makes sense that in some cases you need to subtract excess cash because it's not being used.
Right.
Capital employed means that the capital is actually being used to run the company. If it's excess cash, it is not being used. So in some cases, it might make sense to take it out, and that's why some people do it. So return on capital employed, that was it. Abbreviation for that is ROCE. You'll see that sometimes in financial reports. Let's move on to our next profitability ratio, return on capital, return on invested capital, ROIC. Define for us what it is, Ari.
So return on invested capital is, so you're taking the same thing, you're taking operating income, but taking out the tax that a company will pay. So you're still using the interest payments are excluded is essentially. So what you're trying to do here is compare like companies with excluding their financial structure, right? So when you do return on equity, the debt is subtracted out. So companies with higher debt could have a higher return on equity, right? So it kind of fakes you out. So with a return on invested capital, what you're doing is you're actually doing the assets plus the liabilities with the operating income minus the tax rate, right? So you take out the taxes, but you're still left with so you're essentially left with let's exclude the leverage that the company can employ and see how much, what is their return on any money that they have that they've already used, and what debt do they also have. So it's very similar to return on capital employed. You're just using a slightly different kind of setups, right? But in both cases, you're trying to eliminate the idea of return on equity where you can load up with debt and make your return on equity look higher.
Yeah, return on invested capital. Again, I just want to re-emphasize this point that you might find these ratios kind of daunting at first. We talked about return on equity, return on capital employed, all these ratios. But again, I want you to have this in mind. This is all same thing. It's all, okay, how much did the company make in some form of return, be it net income or be it EBIT or be it whatever it may be, divided by some measurement of how much does a company own, or what is the capital base of that company. And so that could be equity, that could be asset, that could be some form of that.
Yep.
So it's all derivative of that. And, honestly, I personally sometimes make up my own thing, just kind of mix and match kind of thing, just to see what the ratio shakes out. So if you just remember that overall formula, you can do that.
Yeah, I mean, what I would say is if the return on equity and the return on capital employed or return on invested capital are vastly different, then you should probably be sticking with the return on capital employed or return on invested capital, because that'll take into account the heavy debt load. But if return on equity and the other two are the same or roughly the same, then it doesn't really matter, right? So just these are just metrics to tell you how much, how good is this business at taking money, deploying it back into its own business, into its operating business, and to make more money, right? Because what you don't want is a company to just keep throwing money and not really actually getting a good return at it, right? And there's tons of companies that do this, right? So there are tons of companies that have return on equity of less than 10%, right? And the result is, you're just wasting your money with them.
Yeah, it's opportunity cost.
Right.
Right. Opportunity cost. You could have deployed that money into something more profitable, and that's what we're doing as investors.
Right.
Okay, so those are the profitability ratios. And before we mentioned profitability ratio, we talked about the margins: gross margin, operating margin, net income, profit margin. Okay, that is it. Do you have anything else to mention in this episode, Hari?
Nope.
Okay, again, just to reiterate, this is very, very important, and we will revisit this when we are actually analyzing companies in future episodes. This will come up again and again. So if you don't understand this fully, it's okay. We will go through this again. Okay, that is it for episode 23, and thank you guys for joining us. We'll see you on episode 24. Thank you.
Thanks.